I will start with my issue, which is the factor that influence penetration of life insurance in Malaysia. The first one is service quality. Poor service such as claim delay, misrepresentations of policy terms, unclear benefit explanation, and aggressive selling tactics discourage customers. This negative experience reduces customer satisfaction and trust, leading to lower life insurance uptake. The second one is awareness. Many people lack knowledge about the purpose and benefits of life insurance, and common misconceptions such as it's a scam or only for the wealthy persist. This leads to mistrust and disinterest in purchasing insurance. The third factor is age. Younger individuals often see insurance as unnecessary, while older individuals are discouraged by high premiums due to age-related risks. Both age groups are less likely to buy the insurance, reducing overall market participation. The fourth one is income level. People with higher incomes are more able and willing to afford insurance, while lower income groups prioritize immediate expenses. Income disparity leads to uneven insurance uptake with lower penetration among low-income populations. The fifth one is education. Education improves financial literacy, helping individuals understand the value of life insurance and how it fits into long-term planning. Better educated individuals are more likely to purchase insurance, contributing to higher uptake. The sixth one is trust in insurance provider. Lack of trust due to past fraud cases, denied claims, and unclear policies makes people hesitant to buy insurance. Fear and skepticism prevent many from committing to long-term policies, lowering industry growth.
The second one is lack of understanding of policy term in health insurance. So the first one, ignorance of the coverage limits. Many policyholders are unaware that their insurance only cover a specific amount. They believe that all treatment costs are fully covered. The second one is misunderstand when the coverage starts. Many people believe insurance coverage begins right away. In reality, several treatment can only be claimed after a waiting period, often 30 to 90 days. The third one is fully relying on agent. Some people only listen to explanation from agent without checking the policy document themselves. For example, the agent says all hospital covered, but claims at non-payment hospital are rejected. So next, the fourth one is confusion about uncovered treatment. Many individuals think that all treatment are covered by their insurance without carefully reading their coverage. For example, they assume dental is covered, but the claim was denied. And then the last one is failure to review policies regularly. Some people do not check their insurance policy from time to time, so they may miss update, changes in coverage, or forget important terms.
Next, I will continue for the third issue, which is behavioral challenge, moral hazard and fraud. What is moral hazard? Moral hazard occurs when someone starts acting more carelessly after buying insurance. This is because they feel financially protected, so they take more risk than they normally would. For example, someone might drive recklessly or skip regular health checkup because they believe insurance will cover the consequence. Next, what is insurance fraud? Insurance fraud happens when someone intentionally lies or manipulates information to get money from an insurance claim. It can be hard fraud, like faking a car accident or staging a theft, or a soft fraud, which is more common, such as exaggerating the amount of damage in the real claim. Both types of fraud are harmful and costly to the industry. These problems usually arise from the lack of awareness and personal responsibility. Many people don't fully understand how insurance works and assume it will cover everything, no matter the situation. This mindset causes a carelessness. On the other hand, some people purposely abuse the system of personal financial gain, knowing that fraud can sometimes be hard to detect. The effects on the industry are very serious. When fraud and moral hazard increase, so do the claims costs. To manage this, insurance companies are often forced to raise premiums, not just for the wrongdoers, but for all the customers. Small insurers may struggle financially and eventually shut down, which reduces the market competition. For customers, especially honest ones, the consequences are very frustrating. Claims take longer to process and procedures become more strict because the company are trying to prevent fraud. This leads to their dissatisfaction. Over time, some people cancel their policy and choose not to include insurance in their financial planning anymore.
Inadequate risk assessment in financial planning. This slide explains the consequences of not properly assessing your risk when planning your insurance. First is underinsured. This means a person doesn't have enough insurance coverage. If they get sick or get injured, the insurance might not fully cover their hospital bills, daily expenses, or income loss. This leads to high out-of-pocket costs, especially for serious accidents or illness. Without proper coverage, people will face increased financial burden, which can affect their quality of life and their ability to recover. Second is overinsured. This is the problem opposite from underinsured. It is having too much insurance. People often buy more coverage than they need, either from fear or poor advice. They may have overlapping policies or benefits that they don't actually use. This wasted their money and pulls resources away from other goals like saving, investing, or paying off debts. Third key features is gaps in coverage. These are missing protections in someone's insurance plan. Key risks like illness, disability, or accidents might not be covered at all. When this unexpected event happens, the person is financially exposed. This can lead to major financial hardships, especially if the event causes job loss or ongoing expenses. Fourth is financial strain. This is the result of being underinsured or having coverage gaps. Without insurance, people might have to use their savings, taking loans, or even sell their belongings. This puts them under stress during emergencies when they need stability the most. It also causes delays in major life plans like buying a house, starting a family, or retiring. And lastly, inadequate emergency preparedness. This is the overall lack of readiness for financial shocks. People often don't understand the full range of risks that they face. So, when something bad happens, like a job loss, accident, or a natural disaster, they're completely unprepared. This can slow down their recovery, increases anxiety, and may affect their mental health and long-term stability.
The issue I focus on is the low awareness of disasters insurance in high-risk flood areas in Malaysia. Despite experiencing severe floods almost every year, especially in states like Kelantan, Johor, and Pahang, many households still remain uninsured. This leaves families exposed to serious financial risk when disasters strike. There are several reasons behind this. First, many people mistakenly believe their basic home insurance includes flood coverage, when in fact, it often does not. According to Bank Negara Malaysia, only 6% of homes in flood-prone areas are insured. Secondly, affordability is a major barrier. Premiums are higher in high-risk areas, making disasters insurance inaccessible to lower-income households. Because of this, many has relied on government aid, which is often delayed and limited. Another major challenge is the complexity of policy terms. The language used in insurance documents can be technical and confusing, leading to uncertainty and mistrust. Many people aren't even sure what their policies are actually covered. Finally, there is a lack of education and outreach. Disasters insurance is rarely promoted, especially in rural communities that are mostly vulnerable.
Continue with the reflection, lesson learned, and future improvement. For the issue of factors that influence penetration of life insurance in Malaysia, the reflection is many Malaysians still lack awareness and understanding of life insurance, leading to low participation. Service quality such as responsive and trustworthiness plays a vital role in influencing insurance uptake. Younger individuals are less likely to purchase life insurance due to lower awareness or other financial priorities. Demographic factors such as income and education levels significantly impact people's decision to buy insurance. For the lesson learned, financial education is crucial to increase public awareness and correct misconceptions about life insurance. Improving service quality can help insurance providers build stronger relationship and trust with clients. Target marketing is needed to attract different age groups, especially the younger populations. Inclusive product design with affordable premiums can help reach low-income or less educated individuals. And lastly is the future improvements. Enhance financial literacy programs nationwide to improve public understanding of life insurance benefits. Invest in service quality by training agents to be more responsive, professional, and trustworthy. Use digital platforms and social media to reach and educate younger age group more effectively. Design flexible and affordable insurance plans to cater to different income and education levels. And develop target awareness campaign for specific groups such as youth, rural communities, and informal workers.
So, for the lack of understanding of policy term in health insurance, for the reflection, many consumers buy health insurance without fully knowing the benefit and condition. The second one, during emergencies, a lack of awareness causes shock and financial stress. The third one, understanding coverage terminology can help you prevent unexpected medical bills. And the last one, clear communication and education on insurance policies are essential for making sound decisions. The second one, for the lesson learned, the first one, before agreeing to anything, always read and understand the policy. The second one, do not depend solely on the explanation provided by your insurance representative. The third one is clear understanding help to reduce surprise costs and make claims easier. The fourth one is review the policy on a frequent basis, especially if your circumstances change. And the third one is the future improvement. So the first, explain policy concept with short movies or visual tutorials. Second, add a clear policy summary element to apps and website. The third one, regular follow-ups can help agent and customer communicate more effectively. And the last one is assist consumer in understanding crucial information such as coverage, exclusion, and how to file a claim.
From this issue, behavioral challenge, moral hazard, and fraud, I've learned that insurance planning is not just about the money or protection. It's also about the human behavior. Issues like moral hazard and fraud shows that if people misuse insurance, the whole system can suffer. It made me realize how important it is to use insurance ethically and responsibly. From this issue, I've learned a few important lessons. First, ethical behavior is very important. It keeps the insurance system fair for everyone. The second one, insurance is a shared responsibility. If one person misuses it, others have to bear the cost too. And the third one, every policyholder should understand both their rights and responsibility. In this situation, I believe there are a few steps we can take in the future. The first one is public awareness. We need to educate people about the dangers of fraud and the value of using insurance ethically. Campaigns, social media, and workshops can help. Next, use the smart technology. Insurers should use AI and data analysis to detect fraud early and make claim processing faster and more accurate. The third one, stronger enforcement and monitoring. There should be stricter punishment for fraud cases and better system for reporting and investigating suspicious claims. Lastly, simplify policy terms. Insurance documents should be easier to understand, so users know exactly what they're covered for and what they are not.
This slide explores how insurance planning often goes wrong and what we can learn and do better. First is reflection. This section explains the current problems or mistakes people commonly make in insurance planning. First point, many buy insurance without understanding their actual needs and risks. People often purchase insurance blindly. They don't fully understand what kind of risks that they face, like critical illness, disability, or loss of income. Second, risk evaluations are often based on sales advice, not personal assessment. Instead of doing proper financial planning, people listen to their agents or salespeople who may push products for commissions, not what truly suits the client's situation. Third, lack of policy reviews leads to outdated coverage that misses life stage changes. Insurance needs change over time. For example, getting married, having kids, or retiring. Without regular policy reviews, the coverage becomes outdated and no longer fits the person's current life. As for the lesson learned, this column shows what we've learned from those mistakes. It's about key takeaways for better planning. First, match insurance to personal risks and goals, not generic plans. Every person has a unique needs. A one-size-fits-all policy won't work for everyone. Insurance must be tailored to your actual risk, exposure, and financial goals. Second, review policies regularly to keep coverage relevant. Just like a car, they need maintenance, so do insurance plan. Reviewing policies annually ensures protection still aligns with your current life situation and financial priorities. Third, educate consumers to make better insurance choices. Financial literacy is key. If people better understand how insurance works and what they actually need, they can make smarter, more cost-effective decisions and avoid being under or over-insured. As for the future improvement, these final sections, we can look on what can be done going forward to improve. First point, use digital tools to offer personalized risk analysis and coverage advice. Apps, AI, and online calculations can help analyze individual, risk their profiles, and recommend the most suitable insurance coverage. Technology can close the gap between knowledge and decision making. Second, train advisors to focus on holistic, life stage-based planning. Advisors shouldn't just sell policies. They should be trained to understand a client's entire life situation, long-term goals, and stage of life, and then provide relevant advice. Third, conduct annual policy reviews to identify gaps or overlaps in coverage. Yearly check-ins can help spot if a person has too much of one of insurance and not enough of another. This prevents waste and protect against risk blind spot.
As for the reflections, this issue has highlighted how disasters insurance is frequently overlooked even in the areas that face the greatest risk. Many people either do not know it exists or assume they are covered or simply cannot afford it. Heavy reliance on government aid discourages people from taking proactive steps in protecting themselves financially. As for the lesson learned, we have learned that awareness alone is not enough. People also need to access affordability, trustworthy, and clearly explain insurance options. Insurance must be understandable and relevant to the communities it serves. Most importantly, financial resilience depends not just on savings but also on having proper risk protection in place before a disaster happens. As for the future improvements, to address these challenges, we are recommending launching targeted awareness campaigns in high-risk communities. Subsidized or micro-insurance plans can also help, making coverage more accessible. Insurance terms should also be simplified, using visuals and local languages. We also propose using mobile platforms for education, enrollment, and early flood alerts. Finally, collaboration between insurers, government, and NGOs is essential to expand outreach and build public trust.